Oh no. Oh no. This is what the stock market looks like. This here is what the crypto market looks like. This here is what Bitcoin looks like, now breaking through some key levels. You've got, let's have a look here. You got the NASDAQ. The NASDAQ now breaking straight through that trend line. We thought it was going to be a perfect retest. Now it's broken through the trend line. Big question is where it's going to close. You've got all the other charts going crazy today, and that is because we got the inflation numbers. Everybody thought that the inflation numbers were going to be more or less at 8.3%, which is what everyone predicted. And bang, what did we get? We got 8.6%. Basically, the highest inflation numbers that we've seen in 40 years. And I guess the big question is, what does that mean for the markets? What does that mean for crypto? What does that mean for what the Fed's about to be doing? That is what we're going to be talking about today. So it's Friday. It's a big banter Friday. I'm here in Austin, Texas, here for Consensus. But I thought I'd bring you guys a show because I've got some huge guests for you guys today. So without further ado, let's get into it, guys. Let's do it. We're such a bunch of DJs, and I keep forgetting that we're a bunch of DJs because every time I play that song on a Friday and we get new guests and I watch them in the waiting room and they start hearing like, let's get the fuck out of bed, bitch, go. And you just look at their faces thinking, what the hell have we actually signed up for? And who are these DJ nutcases that are here at Banter? So listen, DJ nutcases, if you are here, all 3,000 and 3,500 of you, welcome. Smash the like button. Subscribe to the channel, let everybody know we're here, and we're bringing you an emergency. It's a YouTube emergency because inflation just hit 8.6%. So all these assumptions that we've had and all these discussions that we've had around inflation coming down and maybe the Fed managing inflation and maybe the Fed taking an easier monetary policy later on in the year. Remember, we said that the Fed's going to increase interest rates by 0.5% next week when they meet at the FOMC meeting. And then the Fed's going to increase again in July by 0.5%. But then we all kind of subscribed to this thing that maybe the Fed was going to take a break. And that maybe by then inflation would be under control and we would see inflation coming down. And then, bang, that's what it looks like. 8.6%. So not only did it not come down, not only did it not stay where it was, inflation is actually going up. Despite the fact that the markets are cooling off, inflation is actually going up. And the Fed has lost complete control of the markets. That's what we're going to be talking about today. And I've got a crazy panel with me today. I think today is going to be one of our bigger shows because the guests that we've got here, my goodness, big guests. One of them even calls himself a rogue economist. All right, so without further ado, let's get into the Friday Banter. And just a reminder that Friday Banters are brought to you by NordVPN. I've said this to you guys 1,000,001 times. I said to you guys, don't survive the bear market and then get caught out by making a stupid mistake on your crypto. Don't do that. And one of the most important ways to keep your crypto safe and to stay completely anonymous while you are trading your crypto is to use a VPN. Because what a VPN does is it masks your computer's IP address. And so that means that exchanges and crypto service providers, governments don't know which computer is interacting with the exchanges. Also, they don't know where you're interacting. So you protect yourself against hackers. Now, everybody should be using a VPN. If you use the referral link below, if you use the referral link, which is just under here, You can see where it is. Here it is. Let me show you where it is. So if you use the referral link below, which is right over here under the stream. Guess how much you pay a month to protect your crypto? You pay $3, I think. I think it's $3. Here we go. You pay well, £2.39. So you pay $3. You see, this is how smart a VPN is. My VPN thinks I'm in the UK now, and I'm actually in the USA. See, that means that I'm not going to tell you why. Actually, I will tell you why. Because I'm surfing US exchange. I'm surfing exchanges, and you can't surf certain exchanges in the United States. So I had to put my VPN on, and here I am. I'm surfing the VPN, but I'm not American. So, all right, let's do this. Let's get into the Friday banter. Let's talk about how bad these inflation numbers actually are. It's going to be big. I'm telling you, it's going to be big. I've got a rogue economist with me, Herry Dent. Herry, welcome to the show, my friend.
Oh, nice to be here.
Man, I'm so excited to have you on the show because I think if I heard correctly, you're calling for an 86% correction on the NASDAQ. Am I right?
On the S&P 500, maybe 90% plus on the NASDAQ.
90% on the NASDAQ.
Yeah.
So you're saying the S&P is going to like 500, basically. You're saying, let me quickly.
I think 670 on the S&P is my target.
670 on the S&P is your target.
Yeah. That's a lot lower than here.
Hold on. Are we talking about, I just want to make sure we're talking about this. You're talking about this S&P, the one that is at 3,900.
Yes.
You're saying this one's going to 600.
Yeah. 670.
Oh my. Oh my. Oh my. And how much of that is related to what we've just seen in the inflation numbers?
Okay. Inflation is the penalty of the central banks continually stimulating an economy that already peaked in the U.S. and most Western countries in 2007. We had that big crash in 2008-9. They panicked. They've been printing money ever since, and mostly since COVID. So basically, we have to just go back down to normal. We should have seen a peak in the stock market back then, roughly. So now we've gone much higher with all this stimulus, and we're going to have to go much lower to get back down to reality.
Oh my goodness. All right, Michael Gade, welcome to Banter, my friend. Oh, we can't hear you. You're on mute. I think you may have muted yourself, unless we muted you.
I'm all good. Sorry about that.
You're all good. All right. All right. So what do you think of what Harry's saying? You think there's a chance that we could be going down to 600 on the S&P?
I mean, if that's the case, then we should all be buying guns and butter, all right? Because the reality is, I would argue, and that's not me necessarily disagreeing with Harry, but if you have a situation where you basically retrace the post-Great Financial Crisis rally, that sounds like an end-of-the-world situation given how much leverage there is in the system. Now, again, that's not me countering Harry, because I think there are a lot of interesting arguments around the longer-term thesis for deflation and how much trouble we are in because the Fed simply kept on kicking the can down the road. But we will have much bigger things to worry about than rocket ships and moon and diamond hands and all the emojis we see on Twitter.
Okay, and Andreas, welcome to Banter. I want to ask you a question based on what Michael's saying. So sometimes when I go on party binges, so I go out for like 3 days in a row without sleep, and I drink a lot during those 3 days, and I get really, really, really drunk. But then eventually I have to face the music and I have to face the hangover. So I do it to avoid the hangover. And then what happens is I eventually get so like I just have to face the hangover. Is that what's happening to the Fed now? Is this it? Is this the end of their 3-day binge party, and is this the beginning of the hangover?
It probably is. I mean, to me, a lot of what's going on now relates to the so-called average inflation targeting that the Fed launched back in 2020. So they waited and waited and waited for the actual inflation to arrive, and now they will have to do a lot to get it back down to target, which basically means that risk assets will have to sell off.
Oh, wow. Okay, so let's talk about the inflation numbers. So we are at 8.6%. That's what we got today. I mean, scary, because I think most economists and the consensus was that we were going to get to 8.3%, and we're on 8.6%, and that's, hold on, let me just get that over here. So there we go. We're on 8.6%. Most people expected it, because we had a little downturn the time before. Everyone expected that maybe we were going to get closer to 8.3%. But then, in all fairness, the White House did warn us, and we kind of know that when the White House warn us, they've got this habit now of starting to warn us when they're going to give us bigger inflation numbers. Now we've got the bigger inflation numbers. So what's the Fed's next move?
I can start on that. I mean, I think they will have to go with 75 basis points next week as a consequence of this. I think most people agreed last month that the peak was in year-over-year terms, at least for inflation. So this is a game changer, even though it is mostly driven by the gasoline price. Obviously, the gasoline price is probably the highest priority at all at the White House right now. So if the Fed acts on behalf of politicians, and obviously they do, they will have to do more than already anticipated.
Harry, what do you think? I mean, if I'm looking at the numbers here, I see that right now, as it stands, and I mean, this is only a couple of minutes old. The news is a couple of minutes old, but what you can see here is that they're still talking about a 50 basis point increase for next week. If I look as far forward as the July meeting, all right, now we're starting to get a slight chance of a 75 basis point increase in July. So not June, but now there's a 34% chance of a 75 basis point increase in July. What do you think, Harry?
Well, yeah, they're going to have to do this now. They're the ones that overstimulated since COVID. I mean, massive fiscal, $5 trillion in fiscal stimulus committed, $5 trillion in monetary just in the last 2 years. This is 50% of GDP. Okay, with that sort of stimulus, we should be growing at 20% a year and have inflation super high. It shows how weak the economy is since the baby boom peaked in 2007, something I forecast decades before. And the millennials do not pick up the slack and drive us up until 2024. We're in a weak point in the economy. Governments have been stimulating. Now they've gone off the charts. Now they've gone too far, and things are going to back off here. I think we're going to be in a deep recession by early next year, and stocks are going to go down a lot because they've done everything they can do so much that they got inflation so high. I tell you what, inflation, I have the best inflation indicator in the world, workforce growth. Inflation should be at 1 to 1.5% today, and it's been trending there since the peak back in 1980, okay? It should be 1.5%. It's at 8.5% only because of this money printing to prevent the downturn, which now makes them tighten to say we're going to have the downturn. The government, the Fed, the central banks have checkmated themselves here. We're going down in the next 2 years, I see, period.
Okay, so I'm looking at an inflation chart. The light blue here is the inflation chart. The dark blue is the Joe Biden approval chart. Okay, so I think what we can see is that the higher inflation goes, the lower Joe Biden's approval goes. So, I mean, I'm sure there are other factors. I mean, I'm sure it's not a one factor issue, but it does feel like they really have no choice but to manage inflation. I mean, it does feel like, even though we're sitting here crying about the markets and maybe the Bitcoin price, it does feel like for the man in the street, inflation is the biggest enemy, and maybe the only thing they can do right now is manage inflation. Maybe that is what they should be doing. What do you think, Mike?
Yeah, let me. There are two truths. Okay, one is that inflation is probably a lot higher than what's being reported.
A lot.
All right, and the other truth is that the Fed has no fucking clue what's going on. Okay, and I don't say that as a critique of the Fed. Nobody can predict the future. Nobody. There are no gurus. There are only cycles. Everybody tries to think they can anticipate what's coming tomorrow, but nobody really knows. But the Fed does control the conditions, right, through liquidity, through all of their actions. From that standpoint, the notion that the Federal Reserve can control this is a little bit silly to me, because look at how much wealth has been destroyed in cryptocurrencies, in the bond market, in the stock market, pretty much everywhere except commodities. I've said this point many times on Twitter before at Lead Lag Report. The stock market will break inflation faster than the Fed. And what's really going to push the Fed's hand to maybe lower rates again at some point, probably sooner than people realize, is housing, which I'm sure we're going to talk about. But that, to me, is going to be where you have some real problems, because that's historically where real problems start from.
Harry, I know you've got a view on housing. I know specifically you think that housing is the final frontier of this battle. Maybe do you want to just elaborate and just walk us through what happens now around housing?
Well, first of all, I don't agree about forecasting the future. That's what the hell I do, decades in advance. I predicted in the late 80s that the baby boom would peak in spending in late 2007, where without all this stimulus, we had a glorious boom, and then we started going down. And that's why we've been living off of stimulus ever since. And now it's more difficult because the stimulus is just gone, off the charts, and they're getting diminishing returns, something for nothing, which you should. So this is a whole different thing. We have to come back down. The stock market should be near its lows in long-term cycles. There are cycles, 40-year cycles in generational spending, 45-year cycles in technology. These are the biggest things I find that drive our economy. We're near the lows of both of those, and the stock market is not reflecting it. Why? Because all of this stimulus, which goes into, look, did they send us checks in the mail? No, they didn't until recently. They put all the money into buying financial assets, propping up the stock market, bond markets, everything else. And now we have the most overvalued markets in history, when the economy, by natural forces, which if somebody measures them better than me, I want to see them. But I predicted the great boom in the 80s when nobody thought the US could ever go back to new heights and Asia was taking over. Now I'm predicting we should be at our lows here in 2020 to 2023, and stock markets that are high. So there has to be a readjustment in the stock market to get reality. And it's because the Fed stimulated so hard in the last 2 years that they're forced to raise rates exactly when the economy can't take it. That's my view. The economy cannot take this rise in rates. The Fed's going to be forced to do it anyway because they went so far and inflation came back so fast. It should be 1%. It's 8.5%. Oh, that was all on the Fed. The 15% inflation in the 70s was all on the baby boom generation entering the economy at great expense. Whole different phenomena. This is short term. We're going to see deflation before we see inflation again in the next few years.
I will say real quick on that. I tweeted that out a little bit earlier today. Inflation short term, deflation long term. If you understand this,
explain it to us.
Well, because exactly to Harry's point, which I agree with, demographics are destiny. Yeah. Right. So this is not opinion. This is fact. Just because the U.S. has been the outlier against an aging, developed economies globally and has done so well, it doesn't mean that weight won't at some point bring asset markets back down. And the other part of this is that leverage is inherently deflationary because at some point leverage causes default risk. And every single response by the Federal Reserve is to re-lever every time you have a black swan. Well, then guess what? If leverage is a necessary precursor to every crash is inherently deflationary. At some point, you get a real big one that the Fed can't re-lever up.
Is this the one?
I will tell you in 10 years.
Okay, but wait, you're talking 10 years, but Harry's talking 2023.
I'm talking now. They just blew it. They just went so far on money printing and now fiscal, 10 trillion, 50% of GDP, and we're near a recession again. What does this tell you? The economy died in 2008, and it does not revive until 2024 when the next generation, the millennials, drive us up again. So we have to come down to reality. All this stimulus has to come down to, no, we're in a weak economy, and if we get rid of all this excess stimulus and financial asset prices, it'll be easier to go for the next generation into the next boom from, which I've said 20, 30 years ago, 2024 to 2037 is the millennial boom.
Okay, Andreas, what do you think?
I mean, you guys make it sound like rocket science to forecast demographics. I mean, as far as I'm concerned, it takes roughly 20 years to grow a 20-year-old. So, I mean, they're fairly easy to predict. But I agree perfectly with your point that demographics is basically the variable to use when you predict interest rate markets and inflation. So we are headed in that direction. The big question here is, how do we solve the debt issue if we go to inflation levels below 1% again? We simply need interest rates below that level to cope with debt levels in that case, in my humble opinion. So it makes central banks forced into creativity again.
Yeah, can I bring something up around that? Because I think it's an important thought experiment, which is that you can never solve inflation unless you solve incentives and unless you have some kind of incentive system that prevents politicians from constantly promising more to get voted in. You can never, ever lower this debt unless you have somebody saying, take the hard medicine. The problem is you can't get it voted in for austerity.
Okay.
You have to write off bad debts. We have the greatest debt ratios in all of history, all around the world. Nobody wants to write off these debts because companies and countries will fail. You have to write these debts down to reality, just like any company, succeeding and then failing. And I've managed several companies in my lifetime. You have to get down to reality to get into the next boom. We're not doing it now. The next boom will be compromised if we don't let debts get written off. We have to let bad debts fail, the highest bad debt ratio in history.
But no one's going to let the bad debts fail because, like you say,
the economy will. The economy will force this, and I say it's doing it right now. Only because central banks overstimulated. Are they having to tighten now? They don't want to. They know how weak it is, or they wouldn't have had to stimulate it nonstop for 14 years. So they know it. It's forcing it down, and this will force these debt reductions, whether we like it or not. And it'll be the best thing that happens long term for our kids, who are the millennial generation.
By the way, real quick, and I've said this point before on the lead lag report, that student loan forgiveness is the initial path towards government debt forgiveness, right? So that be aware of what's happening with this debate around forgiving student loans. I think that's going to be the precedent.
It sounds like student loans are starting to be forgiven. I mean, it sounds like the direction is going towards student loans being forgiven, right?
Yes, but I think the question is, will the population, will the populism push back on that, right? Especially because now it's a midterms and people start saying, well, if you're basically forgiving debt, you're basically adding debt. You're just shifting it somewhere else, and that means more inflation.
Yeah, and why forgive debts on the people in our country that have the highest potential, the young millennials who borrowed all this money to get higher education? So yeah, I think this will all be resolved by the economy. But yes, this is a dilemma.
Wow. Okay, so I mean, with what you're saying, so stock markets, Herry, I mean, I'm going to use Harry's scenario. Harry says, because he's the worst case scenario, he says stock markets are going down 85% from now. Just quickly.
From the top, recent top.
From the recent top. Okay, before we go any further, Michael, what do you think? Are you're not calling for 85% down on the S&P, are you?
Oh, I have no idea. Again, I go back to what I said before. I don't believe anybody can predict the future. That's just my own personal viewpoint, but I go back to conditions dictate probabilities, probabilities dictate outcome. Can you make a case for a very severe black swan event unequivocally? Because again, leverage is so incredibly high. And by the way, uneducated speculation is also incredibly high. The fact that we got to this point in history where there's so much gamification of what is a very serious endeavor, putting money at risk. And we got to a point where people don't spend the 10,000 hours necessary to actually understand the domain of investing, just like understanding anything. It takes hard effort, more than just looking at a damn chart. That's oftentimes what becomes the precursor for generational shocks. So I go back to, it's about conditions. I have no idea. Yeah, I tell you though, if that happens, I'm probably going to move to Puerto Rico.
I mean, I want to ask you, Herry, in this scenario, what would earnings do? I mean, PE multiples must contract to below 1 or so.
Yeah, it's the earnings go down, the revenues go down. It is, like you say, the price earnings multiple. When people are positive about the future, they can get up to 20, 30, even 40 at extreme. When people are pessimistic after a long downturn like the 70s and early 80s, or as we've seen, intermittently recently, they go way down. It's the valuations are everything. I'm not as pessimistic about the economy, although I am. The worst downturn we've seen, worse than 2008-9. I'm more pessimistic about high stock valuations and asset valuation and real estate valuation around the world, globally for the first time, collapsing. It's the valuations, the expectations of the future. We've been on a nonstop boom since 1983 that should have ended in 2007, and central banks have extended into 2021, 22. This is going to be a huge drop in expectations, and that's why I see the markets going down so much. Not forever, just the next couple of years. Then the millennials will bring us out of this, but the millennials cannot bring us out of this fully until we deal with the excessive debt and valuations and financial assets. I'll tell you, with no predictions of the future, and I do predict the future, okay? But with no predictions, if you bought stocks today, you would lose 2% a year over the next 12 years just because of the damn valuations. This has got to go down one way or the other.
Now, by the way, real quick, I think this is also an important point, since it hits on this topic of forecasting a bit. I always use this line that it's not about prediction, it's about path. it's the sequence of returns that often gets people into trouble, right? Because it's not necessarily the endpoint. That path is really going to be important because we know for sure that policymakers are very creative at preventing creative destruction. So we don't know, right? Could end up coming sooner than not, could end up coming later than not. But we do know that in between now and then, there are going to be a lot of these rip your face off rallies. There are going to be plenty of these periods where it looks like all this gets delayed further. And that's why this is going to be a very challenging environment for many, many years to come. And by the way, I talk from the perspective of somebody who has these funds that are entirely focused around the sequence of returns, where the funds have done not well at all because treasuries have not acted as the risk-off safe haven. If Herry Dent is right, I kind of welcome that, because that would mean treasuries are probably going to have a tremendous drop in yield, which would coincide with stocks.
Yeah.
Okay, well, let's not go
near zero.
I want to go there. I want to go there in 1 second. But before we get to treasuries, I think we do need to talk about treasuries. I want to go back to this, and I think that a lot of people are not. That I want to talk about this because I think this is a very, very, very uncomfortable topic. And the reason why I think this is a very, very uncomfortable topic is because not everybody owns stocks. Not everybody invests in the stock market. Not everybody invests in treasury yields. But most people in the world have a home, or not most people in the world, but a lot of people have a home. And they cherish that as the one asset that they have, that they can mortgage, that they can take credit against, that has actually been appreciating in value and makes them feel a sense of comfort, right? Now we're seeing signs that the US housing market is not as strong as we thought. Maybe it's not a 2008 scenario, but certainly the US housing market is not as strong as we thought.
Good.
Now, let's talk about the housing market. And because I think this is the elephant in the room. This is what people don't want to talk about. So let's talk about the US housing market. We'll talk about the US. I mean, the contagion is spreading to Europe. We know that. What happens in the housing market? Michael, why did you publish this tweet?
So my Twitter profile picture has me, instead of having laser eyes, having lumber and gold eyes. Why? Because the 2015 Founders Award paper that I published basically documents this idea that lumber is a leading indicator for the markets, for tail risk, for the economy, because of the link to housing. And if you haven't noticed, lumber, since that tweet I put out in March, has been pretty much straight down. That kind of makes sense, right? Because you need to have a breakdown and a reversal in housing with this mortgage rate shock that's taken place against the backdrop of real incomes that are way, way less than they were last year. And to your point, most people's assets are in their homes. Whenever people talk about the Federal Reserve and the wealth effect is not about the stock market. It's about housing. Always has been, always will be. The Federal Reserve itself said that during the great financial crisis. So from that perspective, if you're going to break inflation, you've got to break the stock market, you've got to break housing. It's all one big fucking leverage trade.
Okay. Harry,
I could not agree more with this. Housing, this is the second major housing bubble. We didn't even get a big housing bubble in the roaring 20s because people couldn't afford to get mortgages back there. It wasn't so easy. So this is the biggest thing that you're right, that affects everyday people. Second housing bubble, the last one crashed 34%, more than in the Great Depression, minus 26%. I think this one's going to be 40 to 50% higher than the last one. This is going to be the biggest impact on people when they see their housing go down and they go in negative equity. I mean, lending is going to go to crap, and people are going to get much more conservative. I think this is the number one issue. The housing crash affects people, like you said, Ron, more than stocks, because almost 70% of people roughly own a house, and it doesn't go down as much. But I'm saying 40% plus. We saw what happened in 2008-9 with 34% down in housing. This is going to be worse. This is going to be the biggest factor for the banks losing money and people losing confidence in the economy and pulling back in their spending.
By the way, real quick, can I add something on it? Because Herry mentioned, and I do want to hear, Andreas, I'm curious about the European perspective here, but you mentioned second homes in that statement. And
yes,
this narrative, I'm very anti-narrative. I rant against narratives all the time at Lead Lag Report in pretty much every single major asset class. But this narrative that there's a housing shortage is complete and utter bullshit. Okay, because to your point, Herry, when you look at the estimates for the number of homes that are supposedly short, right, that we need to construct more of, the estimate is 3 million. Okay, the number of second homes in the U.S. is 10 million. Do not tell me there's a housing shortage.
Right. Especially second homes that people only buy when they can really feel good.
Right. which is again an offshoot of all this insane liquidity. And Andreas, I recall when you and I did our space on Twitter, I think you had mentioned that you did some private equities work in the real estate space. You want to kind of ask your thoughts that?
I mean, to me, it's pretty clear. If inflation is high, real estate will do well as a consequence of real estate being one of the very, very few asset classes with an inflation protection embedded in it. But, I mean, if Herry is right that deflation is arriving within 5 years from now or so, then, of course, housing will do less good. There is no doubt about it. That is the way the correlation turns. I mean, so if you're upbeat on housing, you also need to think that inflation will stay high.
Hey, real quickly, long-term forecast, and I'm really good at this. The number of homes needed that are bought at the peak of age 41 to 42, typically of generations, we never need to build another house in countries like the U.S., less in Europe, only in Asia, for decades to come. Never need to build another house to satisfy the present demand, because the baby boomers dying will offset the millennials coming up in their house buying and stuff. That we've never seen that ever before. I think this is a peak in the real estate bubble and boom forever in developed countries. This is a first in modern history. So bigger than you can say here. So
you're saying, just to be clear, you're saying that this whole real estate, there are not enough homes, people don't have enough homes. It's all a fake narrative that is created by people that are incentivized or want to be incentivized to get there to make money in housing, or are scared to lose the investment that they have in housing. That's
and up to this point, baby boomers and millennials come along have bought more than they would with such artificially low interest rates. Without all this money printing, interest rates would be 2% to 3% higher. You know what that does to real estate demand? We already see it happening right now. Interest rates just go up a little bit and housing demand slow. I'm telling you, we have overbought real estate in developed countries, US in particular here, for all of time, because the millennial generation, as the baby boomers die, only bring us back up to the peak level of demand, which was actually many years ago in 2002. Okay, for natural demand for people buying their biggest house at age 41 to 42 already occurred. The millennials never take us higher. This is all because of low interest rates cause people to spend more on housing and buy a vacation house they couldn't afford. And this is going to end when the economy goes down and never come back. Housing prices adjusted for inflation, my forecast today, will never, ever go higher than this until long after I die. That's my forecast. So if you want to speculate in housing, you better do it at the bottom, not now.
Okay, so that leads me to two questions. Housing's not safe. Equities are not safe. Okay, so that's gone.
Equities go down more than housing, but housing's leveraged from mortgages, so remember that.
Okay, so I'll tell you what is safe. Gold is safe.
No, it's not.
No. Gold's the big one. The biggest bubble. Gold has bubbled more than stocks. Commodities have bubbled. They all go down. Treasury bonds, the safest U.S. government 10 and 30-year Treasury bonds, especially 30-year, are the best safe haven, as 2008 proved when gold went down late in the stage 50% and the Treasury bonds went up 40%.
By the way, I will say real quick, because that's a good point that Herry brings up, and this goes back to path, not prediction. In 2008, Treasuries really started rocketing and collapsing in yield November into December post-Lehman. There are these lead lag effects when it comes to asset class movement. Now, the word safe is very loaded, right, as we know, because safe implies there's no tails in the distribution. Yes. That's why I said immediately when you said gold is safe, I said, no, that's factually not true, because gold, like every asset class, has tails, right? There's no such thing as a store value. There's no such thing as something that's safe. However, there are junctures historically, we just haven't seen it this year, where when things get very volatile for risk assets, to Harry's point, treasuries tend to be where money flows to. And also gold in those moments in time, but not to the same degree of consistency as treasuries. By the way, that's even in the case in the 70s. It bothers me to no end the bullshit that people say about the way treasuries have acted this year in terms of their drawdown relative to equities, saying, oh, this is what you would expect in high inflation. Excuse me. In the 70s, you never had a sequence of returns where stocks and treasuries were both losing one for one, where the drawdown was as correlated as what we've seen here in 2022. I say that from an emotional perspective because all three of my funds are predicated on the idea that treasuries are the risk-off safe haven asset. They were in 2020. My mutual fund was up 72% back then. They're not this year. All three of my funds are getting slammed, but we live in the small sample. If on average, treasuries tend to act as the safe haven, if we agree that housing is fucked, you better believe that yields have to start dropping to reflect the slowing down of the demand for money on long duration assets, and that has to come.
But I mean, I simply need to break in here. I don't think your thesis makes sense, Harry, because if bond yields are dropping to zero again, why on earth should I have a problem servicing my mortgage? I don't really get that. I mean, then I don't need to pay anything.
It's the economy going down, and that's when businesses fail and jobs get lost. We're going to see higher unemployment than any time since the 1930s. Not 25%, but maybe 15, 16%. That's when people default on their housing loans and all this stuff comes crumbling down. So it's the downturn that stimulates us getting out of la land with endless money printing to keep a dead economy since 2007-8 going. And we come back to reality and people realize, oh my gosh, and companies realize, oh, we're underwater, we're bankrupt, and the whole thing builds on each other. I mean, this will happen at the speed of light in the next 2 years by my forecast. That's what happened 29 to 32, okay? A bubble that kept building for decades finally collapsed from overvaluations of everything, and next thing you knew, 25% unemployment, stock market down 89%. Real estate back then, which didn't bubble because lending was not easy back then, 5-year loans, only down 26%, but everything goes down in this scenario. This is the biggest financial asset bubble in history, and all you got to do is look at the facts to see there's nothing. I can't even compare it to 1929.
Okay, I mean, okay, so you're saying treasury yields are safe. I'm going to get there in a second, but
I think they're going to go to near zero. 10-year treasury yield, 0.4% at least, and it's at 3% now. That's a big drop in yields, a big push to treasury bonds going up 40 to 50% in an economy where all other financial assets go down. It is the only safe haven, as 2008 crash proved. Gold went up in the early stages a little bit and then crashed 50% when things got bad. Only treasury bonds held up in the last crash. This is going to be a bigger version of 2008-9 from my view. And if I'm wrong, I'm wrong. But if that's the case, treasury bonds are the only thing that go up.
Let me understand the gold thesis. So the gold thesis, are you saying that when push comes to shove and people really want a safe haven, then right now it seems that gold has been slightly that place? Are you saying that at some point they're going to abandon it and say, look, the only real use case for gold is, I'm going to say jewelry in India. I mean, I'm going to call it jewelry.
And that's a damn good thing long term. Jewelry in India is going to be the biggest trend for gold for a long time. What gold is this safe haven. If the U.S. dollar goes down and collapses, that's the only case for gold. Gold goes up. I'm saying in the total world, U.S. has less of a demographic downturn than Europe. Europe less than Japan. We're less overvalued. We're going to be the best house in a bad neighborhood in the worst downturn since the Great Depression. And that's why gold does not go up. Gold correlates the most with inflation. Inflation is totally artificial right now. Should be 1%, is 8.5%, is going to go back down to zero-ish or negative. And that's when gold goes down, when it sees inflation is not the trend. And gold is the greatest hedge against inflation. It's not a hedge against financial collapse. And
Harry, you know just as well as me how valuation models are constructed. If you introduce an interest rate of 0 forever in a valuation model, you can basically explain right about every possible valuation scenario in the world. You can have valuations of 50 times earnings, 100 times earnings with 0 interest rates. So why on earth should I expect that values of everything to turn to 0 if interest rates are 0? I don't really get it. I mean, it doesn't make sense.
Now, it is different if interest rates are going down because of high productivity and falling inflation, as from 1980 into recently. It's different if you're seeing a crisis, and that's why the bond yields go up, except for the highest quality. Corporate bonds and stuff go up, and the economy goes down. That's a whole different scenario than when yields are going down because the economy is great and inflation is constantly going lower. Inflation is spiked up. That's a leading indicator. Our economy has to go down to get in reality when the economy goes down, it's the deflation of that, the downturn, that causes these changes, not the inflation rate, because that will quit. I'm telling you, within 2 years, we will not see any inflation. And in the next boom, driven by India and Southeast Asia, we will not see high inflation because labor force growth causes inflation as the greatest in history in the 70s. And it will be low even with the continued expansion of Asia because the Western world is going to continue to slow.
All right, before we get on to, I want to talk about Bitcoin because I mean, we are, after all, we are a crypto channel. It's called Crypto Banter, so it is a crypto channel. I want to talk about Bitcoin. Before we do that, let's just give a big thank you to our sponsors. Give us 30 seconds. We'll be back and we'll be talking about Bitcoin.
This big Friday Banter is brought to you by NordVPN. NordVPN is a security product that every crypto trader must have as part of their essential tools. For crypto traders, NordVPN encrypts your personal data, hides your IP address, and enables you to access crypto trading platforms from any geographical location, giving you the freedom to buy and sell crypto completely anonymously. It also protects you from hackers and phishing attacks. NordVPN is super easy to use, offers security for up to 6 devices, and with servers in over 60 countries, is the fastest VPN out there. The promotional link below gives you up to 61% discount and a 30-day money-back guarantee on your purchase.
Alrighty, we're back, and we're talking about Bitcoin in this, riveting discussion. I must say, I think I'm going to have to watch the show again because it's so, I've just been hearing so many different things. Let's talk about Bitcoin. So you're saying gold is not an inflation hedge. I think I've heard from Michael and I've heard from...
It is an inflation hedge, not a deflation hedge.
Not a deflation hedge. It's not a collapse hedge. Right. You're saying that the safest place to be is with the US government. Basically, you're saying
Treasury bonds, the highest quality Treasury bonds, including other countries. But yes, the US, because the US dollar, like in 2008, went up 40% while other currencies went down. We are the world safe haven, whether you like us or not. 2008-9 proved that.
Andreas, are you in agreement with that?
Well, I like the idea of buying treasuries now, yes. From a cyclical perspective, it makes a bunch of sense. Inflation has probably peaked with this report. I'm trying that view again as a consequence of the economy slowing. I think that's very, very evident by now. Yeah. I'm not sure I buy the structural view that you should own treasury bonds the next 30 years or whatever Herry is saying.
No,
but from a cyclical perspective,
only during the crash. Only during the crash for the treasury. Yeah. It's only the safe haven. It's not the future. No way.
Yeah, but I mean, the cyclical view of the next 6 months, I can perfectly agree with the direction of Herry.
Okay. So, Herry, you're saying the crash is something that's going to happen by 2023. You say that it's next year. You're saying,
well, originally, yeah, but they pushed this off. It looks like it started in January 4th. I need to see one more downturn in the stock market, which I think we're already heading towards into mid-July. That's my target. We're going to see new lows in the stock market. Then the NASDAQ will be down closer to 40 and the S&P closer to 30. That has marked the end of major bubbles. Bubbles have a lot of strength, okay? Just because people think it can never go down after that point. You have to break it with a 30-40% crash. And I think that's what I want to see to say this is clearly a long-term top. And from there on, things just keep breaking down because people see that we can't, this bubble is over, but it takes that to break it. So if we see one more stock market downturn into mid-July, which I am expecting and forecasting, I say this bubble is over. And once the bubble's over, you can't put Humpty Dumpty back together again, even with more stimulus.
What happens to Bitcoin? So what happens? I mean, Bitcoin in your eyes a alternative?
Bitcoin is the epitome of this bubble as the dot-com stocks like Amazon were of the 2000 peak bubble. That was the first tech bubble. Then we had the peak in demographics, 2007, and the second tech bubble. Those are two different cycles into 2020 here. So this is the second bubble here. The fact that tech and crypto has seen the greatest gains here. I see crypto is the next big thing, but it's in its baby bubble, like the internet stocks were into 2000. Big crash, 95%. I'm seeing Bitcoin down to $3,000 to $10,000, probably closer to 3 to 4, and then going up to $500,000 to $1 million as it becomes the standard for the next global currency in the future. That's a long way out. I see it as the next big thing, but like the dot-com stocks, Amazon went from 6 to 136, back to 6 in the early 2000s, and now it then went to 3,500 plus. So that's the way I look at it. This is the next big thing in the technology cycle, crypto, but it is early stages. Real quickly, the best thing ever happened, somebody spoke at my conference and defined crypto as the digitization of all financial assets and money. And that's when I said, holy crap, this is the next big thing. It's just in its early stage, but even early stage bubbles, the first bubbles are the most extreme and they crash the most. I'm expecting 95% down from 69,000 Bitcoin, and then I would load up the boat.
By the way, real quick, for everybody that's watching, if your blood pressure is rising, hit that like button.
Yeah, hit the like button if your blood pressure is rising. If you've just taken a Xanax, hit the like button. If you haven't just taken a Xanax, maybe you should get a prescription. Michael, what do you think? I mean, what happens to Bitcoin in the next 12 months?
You're gonna love my answer. I have no clue, but I will say something which is,
what's the path? Because you said it's
about what's the conditions and how does narrative shape the conditions. So anybody that's followed me on Twitter at Lead Lagerport knows that I am very sarcastic when it comes to narratives that Bitcoin and other cryptocurrencies are quote unquote stores of value, which is such a nonsense marketing term, just like stablecoin was a nonsense marketing term. Look, I'm down with the technology. At Toroso, the advisor I'm under, we run the blockchain ETF, BLOK. I want to see the space do well. I don't want to see the space do poorly because of stupid narratives that cause people to over leverage. The problem that the entire space has is the same problem that everybody that's a risk junkie has, which is everybody sees all this liquidity. They use all these narratives to think that what they're investing in is guaranteed and safe. And then that causes excess leverage, which causes the conditions for the crash. The crash happens. And then, by the way, all this narrative around institutional adoption gets pushed out in time. Yeah. I don't think maxis have thought through the power of words. The more that you keep saying Bitcoin's a store of value, the more that you keep saying that this is the inevitable path and volatility keeps on increasing because of excess leverage, because everyone else starts believing that narrative, you end up causing institutions that you want to adopt Bitcoin to say, you know what, this damn thing has too many tail risks.
Okay.
I mean, ultimately, I think what's most important for Bitcoin short term is what's going on in the Federal Reserve. We've all been used to watching this meme with Jay Powell printing money, like, brrr, right? But what's going on right now is actually that he's trying to reverse that process. He's slowly but surely fishing the dollars back from the private market. And I think that's one of the storytellings that we've gotten wrong on Bitcoin, because essentially all year, people have been told that this process of printing dollars will lead to a higher Bitcoin, but we're actually staring directly into a scenario where dollars will be withdrawn from the market. So if Bitcoin goes up because of dollar printing, Bitcoin should go down now.
Yeah, and again, Bitcoin is just the most leverage. You have the S&P, you have the NASDAQ tech stocks. The crypto is the new thing, like the dot-com stocks back in the late 90s, early 2000s. It is the most leverage. So I agree with that totally. Bitcoin just goes up the most, like 69,000. And what is it? It's gone down 60% when the stock market's down 20 to 30 for the NASDAQ. It is the most leverage. It will go down the most, but it'll be the best buy. And there's 40,000 cryptos now. This is ridiculous. Anybody can start a crypto company. It averts IPOs at great expenses. So this is a bunch of baloney. The leading ones like Bitcoin and Ethereum will go down more than anybody thinks, 95% from the top, and go up more than anybody thinks in the next boom. That's my forecast. It's the leading edge, but it's still early, and it's way overvalued given this early stage. Way overvalued.
So you're saying your buy price would be around $3,000?
3,200 was the low in late 2018. And so 3,000 to 4,000 is optimum, but man, you almost got to start buying it. I'd say 6 to 7. My wife says 10, and sometimes she's smarter than me.
Andreas, what do you think?
I don't have a specific target that I would enter from. I just stay off Bitcoin right now because I know the process of quantitative tightening will take it lower. That makes a whole bunch of sense given that dollars are withdrawn from the financial system, which essentially means that private individuals, asset managers, etc., they are basically slowly but surely tempted inwards on the risk curve, and Bitcoin is the farthest out the risk curve it can be.
But I understand. we all know about quantitative tightening. We all know about interest rates increasing.
Yeah,
That's in the market. Isn't this all already in the market?
But it happens very mechanically. Let me just add that because, quantitative tightening only starts in 5 days from now. So we haven't even seen the effects of quantitative tightening yet because the dollars will not be withdrawn until 5 days from now. And then the process will basically unfold over the next 6-12 months.
Hey, was the market forecasting the future accurately in 1929 or 2000? No. The market
wasn't there.
does work, but it gets overvalued, especially when the dumb money steps in, when everybody comes in the late stages, when it's gone up long enough. The problem with markets is everyday people think the longer something goes up, the better value it is. The smart money sees the opposite. The longer something goes up, the more it's due for a correction. This bull market has not only outlasted the most fundamental demographic trends, which frankly, I measure better than anybody that I know. And now it's gone up just on pure speculation and money printing, all this money going in. They didn't send the checks to consumers up until recently. It all went into buying financial assets. Oh, it starts with bonds and it trickles into higher yielding stocks and real estate every time. This is the most artificial BS stock market and real estate rally in all of history. And there is no way it will end anywhere but bad. And when it does, the millennials will coming and I will buy.
I will say real quick on that use the term dumb money. I'd say instead of dumb money,
very dumb money comes in.
I would say it's the zealots. I keep using that line on Twitter at Lead Lagaport. When an investment becomes a religion, it's time to lose faith.
Well, zealots, that's dumb to me.
And real estate and stocks.
Yeah.
Wow.
But everyday investors, it's not just the richer people that invest more. It is everyday people who would not invest in stocks or very little come in more in the late stages. That is proven. They do call it the dumb money, by the way.
Okay, but so
dumb money indicators, and they're very clear. The dumb money has been dominating in recent years.
So, I'm hearing this talk, and I'm supposed to go to a crypto conference. I'm here in Austin, Texas. I'm going to Consensus. And I'm thinking instead of going to the conference today, I should go to the supermarket and buy beans, oil, sugar,
lentils,
and then just take refuge for the next couple of years.
No, buy the safest, largest bond market in the world, U.S. Treasury bonds. Look at 2008. 2008 was the appetizer for this entree bigger crash.
Harry,
the Treasury bonds were the only things that went up, period. Everything else went down.
You, if I remember correctly, you owned properties in Puerto Rico. Am I right? Is my memory correct here?
I do, because I moved down here and bought a house that was half the price it should have been. Now it's 2.5 times. And guess what? I have a buyer interested. Even though I love the house, I am considering selling it right now. I came into a new area of Puerto Rico, much more undervalued, and then to a lower new area emerging, country club development, and bought a house. It's such a bargain. I bought it at 1.6 million. I could sell it for 3.5 to 4 million today. I am looking at
but do you own anything else in your portfolio other than a house?
No, I do not own
and 30-year government treasury bonds.
Do not own stocks now. Yeah, get U.S. Treasury bonds. ZROS is what I buy. It's a 25-year average versus TLT 20-year. It's a little less liquid, but for me, no problem. Okay.
So Harry Dent, just to be clear, Harry Dent owns a fancy suit, a great house, and 25-year government bonds.
25-year U.S. trade. That's the only thing I'm invested in financial markets right now. Only thing.
Michael, what are you investing in at the moment?
I'm investing in myself, right? And what I mean by that is I'm an entrepreneur. I've got several funds I launched. I happen to launch in the exact wrong time because when you're risk on, risk off in a world where risk off is acting risk on, and I agree with Herry on treasuries. I wrote 5 different research studies that are quant-based, rules-based, that prove out, one, there are leading indicators to certain tail events, to conditions that favor an accident, lumber, gold, utilities, and treasuries, and that 2, treasuries, more often than not, on average, are the best way to play risk off. Better than shorting, better than cash. Treasuries are the risk off asset. Not my opinion. You can do a rules-based back test. You can prove that throughout multiple decades, even though in the small sample that has not worked. Now, signals in the short term are all kind of mixed here because, again, I go back to sequence, path, not prediction. It's very easy to see a face-ripping rally in risk assets. It's also very easy to see a complete and utter crash in risk assets. But the one thing we can have a high degree of confidence in is an extreme is coming.
Okay.
Now, after decades of up, that extreme is way more likely by history to be down.
I don't disagree.
Before we go, Andreas, you own a very beautiful painting I can see in the back. You own a set of headphones. You own a lamp. What else do you own?
You also own some style. I like the furniture in the background. That's good.
Yeah, Scandinavian furniture is very pretty. I mean, I usually go to church on Sundays if I want a dose of doom mongering, but I don't think I need to go on Sunday after having listened to you, Herry. But enough about that. I mean, I remain invested. I have decades ahead of me. So I still own a portion in ARKK. I still have some crypto myself, but I wouldn't add to those positions right now. So, I mean, it's usually a good idea to remain invested to a certain extent. So I wouldn't take Harry's advice. To
Kathy Woods is the leading indicator of this. She bought the most leveraged tech sectors in the end of the top of this bubble, and they are failing first, forecasting next. I wouldn't touch ARKKK, even down here. I wouldn't even touch it because it may be the biggest single fund to crash. And Kathy Woods is still somehow revered by Wall Street because of a couple years of outperformance. She is down 60 to 70%, and the stock market's only begun to crash.
There are no gurus, only cycles. There are no gurus, only cycles.
Yeah, let's leave it on that. There are no gurus, only cycles. Guys, it's been a different Friday banter. It's been I mean, I need to go lie down after this, and then I'm going to go and stock up on beans.
Go on 6th Street. Get a couple of drinks. Awesome.
Yeah, that's exactly what I'm going to do. So if you don't see me at the conference today, I'm on 6th Street. Guys, much love from the Banter fam. It's really been an amazing banter. Exactly what we wanted. You're all part of the family now, so we'll see you guys again all here soon. See you guys soon. Thank you so much. All righty, guys. So that's the big Friday banter. What a different banter it is. What a different banter it is. Before we go, let's quickly go through the sponsors again, give some love to our sponsors. And I'm also going to give away a whole lot of money because that's what we do on the show. So let's do it. First of all, BBS. So we are starting a new BBS early next week, and it's a live trading BBS inspired by Sheldon's live trading show. So go and sign up to the bbs.market/banter. There'll be a lot of posts over there. Then remember, the show sponsor, NordVPN. You need to get yourself a VPN. You see how smart I am? I've put myself that I'm in Texas, but it thinks I'm in the UK because I was obviously trading earlier and I needed to be I needed to be out of the States. So use a VPN, use NordVPN. It is for us the best VPN. It's $3 a month. It protects your crypto against hacks. It masks your IP address and allows you to really surf the internet anonymously. Lastly, let's do some giveaways. So today I'm going to do something really cool. I'm going to give away $1,000 on KuCoin, but on Monday, I'm going to give away $3,000. So today I'm going to give $1,000. I'm going to give the $1,000 to this 0785813 only if you have money in your KuCoin account. How this works is there is a KuCoin link below. Click on the KuCoin link below. Sign up, deposit money into your account. If you have money in your account, you get $1,000 if I picked your name. So I picked 0785813. If you have money in your account, you get $1,000. If you don't, I'm giving it to somebody else on Monday. And on Monday, I'm going to start giving away $3,000. So 3 people will win every single day. That's that. Then there's a surprise. Hang on until the end. Because it is a surprise later. ByBit. Here we go. We do have ByBit. I have the list. Here is the list over here. I'm going to 10x a portfolio because I always 10x a portfolio. Maximum amount that we can 10x a portfolio to is $10,000. The portfolio that I'm going to 10x today is this portfolio. It is 15,312. Okay, so let's go to 15,312. Remember, up to $10,000. If it's more than $10,000, I'm not 10xing the portfolio. If this is your portfolio, you might win. What was it? Let's quickly go back to. Let's go back. Okay, there we go. Man. This guy's got 400 and. What's that? 400. I can't even see that. The screen's so small here. Okay, dude's got $490 in his account. So the guy's got $4,900. So If that's you, you've got yourself $4,900. Well done. All you need to do is sign up using the ByBit link below. Let me show you. It's so simple. This is how you do it. You go to the ByBit link below over here, and you sign up using that link. Don't sign up using any other link, otherwise it doesn't count. You deposit money into your account and we 10x your account. And if you carry on scrolling down here, you'll see that we just done a deal with a company called BitGet. They sponsored us here at Consensus. If you want to go and check out BitGet, you do get up to $5,000 in deposit bonuses. And next week, we're going to be doing a great giveaway. I've just started playing with the exchange. Seems like a great exchange. It's a massive, massive, massive exchange in Asia. So go and check it out. You can open an account, no KYC, also open to US investors if you are a US investor. On Monday, I'm also going to be doing an amazing CoinStats giveaway. So remember CoinStats, which is a portfolio manager that we have. So on Monday, I'm doing actually not Monday, Tuesday. I'm flying on Monday. Tuesday, I'm doing a giveaway with CoinStats. So make sure that you sign up for CoinStats. Listen, guys, I'm going to go to Consensus. Much love to all of you. I'll see you guys on the weekend. There may be a Sheldon stream. I'm going to ping Sheldon. I haven't spoken to him today, but I'm going to ping him today and just find out if he's doing a live stream. Be ready for the live stream. Have your accounts ready. Don't get to Sheldon's stream and then arrive there, and then while he's placing the trade, have to go and open an account and deposit money. It's going to take you time. Get ready. You don't know when the man's going to go live. There has been some volatility in the market. Go and sign up today on ByBit. Get your $4,200 in deposit bonuses. Get a chance to 10x your account. Go sign up with KuCoin. Go and sign up with Mexi, because those are the exchanges that he is using. They're all open to US investors. If you use a VPN, well, no, you can't use a VPN. Don't use a VPN. Bad idea. Bad idea. Bad idea. All right, listen, love you guys madly. I will see you guys again on Tuesday or over the weekend. Until then, trade well, my friends.